Hello everyone, it's me Pimar Farooq. Welcome to Love Money. Today we are going to study about ratios. So let's start. The gateway to valuation, understanding corporate worth. Welcome to our section on corporate worth and operational efficiency. Today we are diving deep into core mechanics of how businesses are valued and how smoothly they run their internal engines. Now I know what some of you might be thinking. Oh great, a lecture on financial ratios. I will just close my eyes, hold my head and pretend I am meditating. But don't start drifting off just yet. Understanding these numbers is exactly what separates market leaders from people who think a liquid asset is just a gold beverage or a hot summer afternoon. We are going to make scenes of chaos, look past the intimidating balance sheet, and understanding how the market actually assigns worth to an enterprise. Valuation ratios help develop a logical quantitative sense of how a company's stock price is being valued by active market participants at any given time. Think of it like walking into a high-end restaurant. The price on the menu tells you what you have to pay, but these ratios tell you if you are actually getting a premium steak or just buying triple for a fancy plate. To master this, we look at three primary pillars: price related to net profit, market price compared to intrinsic net assets, and equity value against top line revenue. The price to earning ratio, the profitability multiplier. Our first major stop is price to earnings ratio, which serves as core multiplier of corporate profitability. It represents the portion of a company's current share price relative to its annual earning generated per share, fundamentally indicating that the market is willing to pay per dollar of profit. The mathematical formulation is straightforward. When analyzing these metrics, think of it through three strategic lenses. Undervaluation: a low PE suggests a stock may be undervalued, presenting a solid entry point for value investors. It's like finding a designer jacket at a garage sale for $10. A PE ratio should never be analyzed in a total vacuum. It must always be analyzed alongside direct industry peers and historical multiplier. Comparing a tech startup PE to a traditional utility company's PE is like comparing a spaceship to a cycle. Both get you somewhere, but they run on completely different physics. Market sentiments. On flipping side, a high PE doesn't mean always a stock is dangerously overpriced. It often indicates strong expectation of massive future growth rather than mere overvaluation. Investors are paying a premium today because they accept a gold rush tomorrow. The price to sales ratio, the revenue reality check. Next, let us talk about a vital alternative for a top-line value measurement, the price to sales ratio. This metric relates the market capitalization or share price directly to a sales value per share. Why do we need this if we already have the PE ratios? Because the earnings can be manipulated by clever accounting choices, but sales are much harder to fake. Furthermore, what happens when an early stage company isn't profitable yet? If you try to calculate a PE ratio for a company with negative earnings, the math breaks down completely. The PES ratio beautifully addresses these challenges. The low PS ratios typically represent an undervalued asset class, making them optimal target for strategic acquisition. Early stage focus. This metric is extremely useful for analyzing companies with a growing top line but temporary net profit deficit, enabling a clear analysis of unprofitability. Highly popular startup. It tells you evaluate a rocket ship before it actually leaves the launch pad. The price to book value ratio, the intrinsic asset floor. Moving along, we have the price to book value ratio, which handles intrinsic asset valuation by comparing a company's market value with its actual balance sheet book value. What actually is book value? Think of it as an ultimate optimistic scenario. It is the theoretical value remaining for stockholders if the company liquidated all assets and paid off all outstanding debts today. P by PV of less than 1.0 indicates that stock is undervalued and the company is strong. If you can buy a company for less than the net value of its physical asset, you are essentially buying a dollar bill for 80 cents. Just make sure those assets aren't absolute machinery or unsellable inventory. Working capital ratios fueling the operational engine. Great, we understand valuation, but how do we know if the business engine is actually running smoothly? For that, we look at working capital ratio to assess short-term operational sustainability. Working capital reflects the net resources required to fuel daily business operation. Positive balance signifies healthy operational liquidity, meaning managing a positive balance keeps a business liquid and operational. You have enough cash and short-term assets to pay your upcoming bills without sweating. Negative balance, indicating working capital deficit risk. This is the corporate equivalent of checking your bank account at the grocery store checkout line and praying your card doesn't get declined. To measure how effectively a company uses the operational fuel to generate top line sales value, we calculate the working capital turnover. A higher turnover implies the firm operational cost effectively with the minimal funds tied up in operation. It means you are spinning your wheels fast and turning raw cash into active sales efficiently. Receivable and DSO, cash flow collection mechanics. Now let's examine the exact velocity of your cash inflows through the lens of accounts and receivable and day sales outstanding. It is one of thing to make a sales. It is completely different thing to actually get paid. First, accounts receivable turnover measures how frequently customers pay credit invoices within a given period. Second, day sales outstanding represents the average cash collection period. DSO is a direct reflection of the collection team's functional performance and department efficiency. If your DSO is creeping upward, it means your customers are treating you like an interest-free bank. Optimizing this collection cycle yields major operational advantages. Velocity of cash. Faster collection minimize liquid cash lockups in unpaid balances. Alternative reinvestments. Rapid collections allow quicker capital reallocation towards core business operation or debt paydowns. Risk mitigation. Lower collection cycle prevents the dangerous build-up of bad debt allowance. Cash is king, but only if it's actually in your wallet. Days inventory outstanding. The Inventory Balancing Act. Next up in our efficiency breakdown is asset cycle speed, specifically measured by day inventory outstanding. This metric suggests the average number of days items sit in stock before being successfully sold to clients. Lesser days better. It implies efficient storage management and prompt conversion of raw materials and goods into active sales. Stagnation risk. Unprogressive rising inventory days signal potential overproduction, weak market demand, or logistical blockages. Operational warning. Unprogressive trends must trigger immediate checks of production details to catch backlogs early. If your inventory days are constantly climbing, your warehouse isn't storage facility anymore. It's just an expensive museum of unsold products. Assets turnover ratio, infrastructure optimization. To wrap up our operational deep dive, we evaluate the overall activity and management efficiency of corporate infrastructure. Using asset turnover ratio, this metric ensures that every single mission, building, and dollar assets you own is actively working to generate sales rather than sitting around and accumulating rust. Metrics focus formula strategic meaning. Fixed asset turnover PP and E. Property, plant, and equipment. Average fixed asset measures how efficiently a firm utilizes its fixed asset to generate sales. Higher ratio indicate and lean and efficient operational capabilities. Total assets turnover, combined asset fixed plus current operating revenue, average total assets measures efficiency across all assets. Combined high total assets turnover compared to history peers, indicating super or capital allocation. By analyzing these frameworks collectively, you gain the ability to look past market noises across industry lines accumulating and instantly spot the difference between a genuinely high performing enterprise and under overvalued illusion. Keep these formulas close, look at the numbers thoroughly, and let's put this knowledge into action. This is the end of this video. We had studied to analyze PE and other ratios. Thank you for watching. Stay tuned for next video on Saturday 6:30 p.m. Bye.